Welcome to episode 4 of our educational series on real estate taxation basics. Be sure to watch our series on 1031 exchanges and passive real estate investing basics. We also encourage you to read our book, How to Retire from Being a Landlord, which you can order for free on our website or on Amazon.
In this module, we'll cover the basic features of funds that invest in development projects located in qualified opportunity zones. We call these QOZ funds for short.
This all stems from the Invest in Opportunities Act of 2017, which added a new section to the Internal Revenue Code. This section establishes the rules and benefits for investing in funds that invest in QOZs.
A QOZ is a neighborhood designated by the government to offer certain tax incentives for development or revitalization. There are over 8,700 QOZs in the United States, all meeting specified demographic criteria.
These criteria were applied in 2018 based on 2010 census data, when many census tracts had not yet bounced back from the Great Recession.
It's likely that many of these zones would have exceeded the maximum income thresholds if the boundaries had been based on 2018 data.
The upshot is that despite the ostensibly good intentions of the QOZ law, much of the money to be invested in QOZ funds will go to projects that likely would have been built regardless of the zone boundaries, on the basis that economic and demographic conditions already supported demand for new apartment buildings, hotels, and self-storage facilities.
In a nutshell, Subchapter Z allows you to sell any appreciated asset that would otherwise trigger a capital gain and defer the taxes by reinvesting just the gains into a QOZ fund. Let's touch on a few finer points here. First, you are not limited to selling real estate. You can use a QOZ fund to defer capital gains from any asset. That could be a property, but it could also be a business or a stock or a pot of gold.
Second, unlike a traditional 1031 exchange, you do not have to replace the entire asset you sold. Rather, you only have to reinvest the capital gain. And if you choose to reinvest only part of the gain, that's okay too.
Third, you have 180 days to reinvest your gains unless there has been an emergency declaration.
Once you invest in a QOZ fund, there are 3 separate and distinct tax benefits. First, you can defer paying federal capital gains tax until after December 31st of 2026. This date may be extended for future groups of investors under amended legislation.
Second, if you invested in a QOZ fund before the end of 2021 and hold the investment for 5 years, you effectively receive a 10% discount on your federal capital gains taxes. Again, it is possible that this timeline could be updated.
And third, if you hold the QOZ fund investment for 10 years or more, all the new capital gains will be disregarded for federal tax purposes.
You may have noticed we use the word federal a few times. That's because a handful of states, including California, have chosen not to conform with federal QOZ laws. If you live in one of the non-conforming states, this means that you could end up deferring your federal capital gains tax, but not your state tax.
Finally, unlike 1031 exchange, you do not have to use a qualified intermediary to invest in a qualified opportunity zone fund. In fact, you could have already received proceeds from the sale of your appreciated asset and put those funds into your bank account, as long as you reinvest the capital gain into a QOZ fund by the 180-day deadline. Even if you had not given a single thought to investing in a QOZ fund until the last day of your deadline, you can still invest into one or more of these funds.
If you're highly motivated to defer capital gains taxes, and if you're willing to tolerate the risks of real estate development in a totally passive and illiquid investment structure, a QOZ fund may be worth considering.
Thanks for watching. Please be sure to watch our other education modules and visit our website at 1031capitalsolutions.com.